Hey everyone, this is Chuck Carnevale, the Chuck in the Market's Up Chuck. And our blog today is about valuation and its importance as both a predictor of long-term investment returns as well as a determinant of how much risk you're actually taking when you're actually making an investment. You know, the Market's Up Chuck, it really has two meanings as our blog. The first is that the market has clearly thrown up on itself in the last year or so, as you know, starting in 2008. And by the way, this using our fundamental research analyzer tool, this is a 15-year chart on the S&P 500, which is, you know, by most considered to be a proxy for the market. And this is what we mean by a hit up chuck. It really threw up on itself. The market has fallen, you know, from its high, you know, back in November of 2007 of over 1,500 to under 764 on February 25th. So that's about almost a 50% drop in just a very, very short period of time, which is certainly an upchuck. But then second of all, there's a double meaning on the market's upchuck, and that is in the long run, the stock market has a long history of rising over its inception. And this is especially true if you get valuation correct. And valuation really explains a great deal, and it's something that isn't being talked about by investors today, and certainly not being talked about by the media. Using our analyzer tool, I want to illustrate a couple important points. The blue line on this chart here represents 15 times earnings for the S&P 500, which over its entire inception has been a historically average valuation, or it's the fair value, if you will, for the stock market. The black line here are monthly closing stock prices for the S&P 500. And as you can see, during almost this entire 15-year period, with just a couple of exceptions, we had where it touched fair value in September of '06. It's currently under its fair value today, and it was reasonably in value for most of 1995. Otherwise, the stock market has been overvalued for most of this decade. Now, what's important about that is when you look at that and look at the return that the S&P generated, it was approximately in value and ended slightly undervalued, and had a 4.5% earnings growth rate during that 15-year period. And you will find that the S&P for that same period of January 31st, 95 through February of '09 has generated a 3.7% rate of return, which is consistent to the company's earnings results and the fact that it ended a little undervalued and started fully valued. A couple of years, in other words, stop this picture at the end of 2006, again, in the beginning of 2007, you see another interesting picture here. Here, you have a more normalized earnings growth of about 9.4%. The market started in value or maybe slightly above and ended in value or maybe slightly above. It had some overvaluation in the middle, but notice what happens to rate of return and how important valuation as well as growth rate is. Here now, for this period, which is a shorter period of time, we have a 9.4% growth rate that actually ended up with a 9.2% rate of return, which is explained by a little bit of the overvaluation, but you can see the correlation to rate of return and earnings growth rate was very, very clear and very, very correlated and precise for the S&P 500 during this period of time. Another fun way to look at this would be just look at the period from 2003 through 2006. We had almost 18% earnings growth during this period in the S&P. Increased by 19.5% in '03, 24% in '04, 13% in '05, and 14.7% in '06. These are historically very, very high numbers, but it started, overvalued based on the blue line being the valuation, the normal valuation, although you could also argue because the growth rate was higher that the green line might represent fair value during this 4-year period. So it ended overvalued. It ended undervalued, started a little bit overvalued, but with an 18% growth rate, we ended up with almost 11% compounded rate of return in the S&P 500 during that 4-year period. Clearly, valuation in combination with earnings growth certainly are the determinants and clearly show the correlations between those attributes and how well the investors or shareholders of the market. Now, to finish this thought as it relates to the stock market, I'd like to look at really the last decade, the last completed decade, and this is really about a 10-year and 2-month picture here. I want you to notice the S&P 500 earnings growth because we've had a couple of drop-offs during the recessionary period here has now fallen to 3% for this decade. But look how overvalued the market was back in, January of 1999. It was trading at over 1,200 when, its typical value would have been about 675. And if you look at the track record of the S&P during this period of time, a $100,000 investment would have shrunk to 65,000, and that's losing a minus 4% compounded rate of return. So even though we did have some earnings growth, although anemically at 3%, because valuation was high and it started overvalued and ended undervalued, you actually lost money during this 11-year period. This is one of the only 10-year periods in the history of the S&P 500 where it showed negative rates of return like that. The key is it was more important, rather than worrying about the recession, because we also had a recession in 2001, I might point out. It was more oriented towards the valuation, and then the fact that the recession did reduce the earnings growth, but overvaluation was the biggest contributor to the bad